So let's make this a really engaging session as well. So my name is Jannah Patchay. I am an executive in residence of Global Digital Finance, a partner of the Digital Euro Association. I'm also an expert member of the DEA and one of the founders of the Digital Pound Foundation, which is the DEA's equivalent in the UK. Clarisse?
Yeah. Hi, everyone. I'm Clarisse Hagege, founder and CEO of Dfns. We're a tech custody provider. We actually are servicing the financial industry, mostly banks, crypto custodian, and fintechs, working with players like Standard Chartered, Zodiac Custody, Tungsten, Stripe. And we've been, over the past now 4 years and a half, securing over 15 billion euros in transactions.
So the topic of today's chat is stablecoins under the lens, navigating security, interoperability, regulation, and market adoption. And this is, for me, the third session in a row I've had today on stablecoins. So obviously a very hot topic at this year's Digital Euro conference. And I think we've seen some of the themes from the two previous roundtables emerging on some of, I think we're getting now to a lower level of detail on some of the barriers to adoption of stablecoins. We're moving beyond just, broader themes around regulatory uncertainty or stability of stablecoins and things like that. And we're getting down to the detail of how do we actually make stablecoins work as an equivalent form of money in all the ways that people want to use money at the moment. And that, I think, is the kind of thing that brings together all of the themes that we'll be discussing today around security, interoperability, regulation. How do we overcome these barriers to market adoption? But to start off with, Clarisse, can you give us an overview of what, is it DFNS or Dfns? Dfns does, please, and how you fit into the stablecoin ecosystem.
Yeah, so, is it working? Hello, yeah. So, I'm a former banker. When I started building Dfns, with the conviction that the entire finance industry will run on chain. Is it within 10, 15, 20, 25 years? The time to market is yet to be defined. But the conviction was that blockchain was such a strong technology that it will bring a lot of efficiencies, right, in the way we actually interact with assets. And so when we build Dfns, with the knowledge that if you want to actually interact with the legacy system of the players we're going to power, we had to build a solution that was first, bank grade in terms of security, second, easy to integrate, and easy to be interoperable with the systems that our clients were actually using. I think I'm going to switch.
That one seems to be working.
Is it better? Yeah, I think now it's more stable. So what we offer is very much the technology for our clients to be able to secure the transaction, but also to enable them to transact on chain. So when you're interlink digital assets and stablecoins, I think at the end of the day, what we're talking about is a transaction and what you need for a transaction to actually go through, right? And there's several kind of life cycle within that transaction. But first, it's make sure that when you initiate this transaction, it's actually broadcasted on chain. And blockchain technology is very new, and some of the network that people and companies are leveraging can be also crowded. And so making sure that you enable your clients to go from point A, from point B, with extreme reliability is the thing that is more important. If we're going to all use blockchain technology, it has to work, I think, at least as efficiently as instant payment through SEPA or through any other network that we're using today on the instant payment. That's the first step. The second step is the security around who has access to this transaction. So this is nothing new, and this is not something that is actually particular to blockchain, and it's everything that is related to the identity and access management. So the permissions around the transaction, who's allowed to actually initiate a transaction, what is the quorum of necessary officers who need to make sure that a transaction go from point A to point B. Has this transaction been analyzed? What is the compliance requirements I need to actually to validate that this transaction can go from point A to point B? And then it's the policies. How do I automate this transaction in a way that we can actually start thinking about programmable money and not just transaction from point A to point B? So do I need to limit transaction? Do I need to put velocity policies around my transaction, etc.? So that's everything that has access both to the identity access management and the policies. And then the third leg is, to us, I think, the most important, but that's because we like to think that we're cybersecurity first before being any sort of tool that enable fintech to transact. We come from the security background, so the last thing is to making sure that this transaction does not get hacked in the middle, right? Obviously, everyone knows blockchain is irreversible, so if you actually get your private key hacked in the middle of this transaction, then the transaction will never go where it's supposed to go. When you talk about security, we can actually go in detail later if this is a topic that we want to drill on, but there's not only the security on which you're gonna safekeep your private key, there's also all the security you put around the management of your key deployment service and the way you transact with your assets. In other words, the corporate security that you're all used to operate with in banks, central banks, fintechs that are mature, etc. And so this is absolutely, I mean, of the utmost importance in our opinion. And when you look at, for instance, what happened with the Bybit hack, going back to those first principles of what we're providing to our clients, actually a service that enables them to go from point A to point B without any, in a compliant way, in the most secure way, going back to first principle and corporate security is actually super important. So at Dfns, when we've kind of built the engine, what we made sure that we built is actually a technology that is completely surrounded by the good practice that we've all been operating with for the past 30, 40, 50 years, that are not new to blockchain, that are very much inherited and that pertain to certain framework our clients are operating with, such as the REF framework, et cetera, et cetera. But happy to, drill down if it's...
Thanks, Clarisse. And we'll come back to a little bit more of the detail on security challenges in a minute. But just to get a sense from the room, how many people in the room do we have who are stablecoin issuers or aspiring stablecoin issuers? Stablecoin infrastructure providers, shall we say? Yes, there's hands up over there. Come on, Nick, you are kind of. How about your business models depend on or will use stablecoins in the future? Okay. People just kind of interested in stablecoins. Right. Okay, so that's where we're at the moment. And I guess for those of you who aren't using stablecoins in your business models at the moment, what are some of the things that are stopping you? I mean, you're at the Digital Euro Digital Euro conference, so you're clearly interested in new forms of digital money. But what is your barrier when it comes to stablecoin usage in your own business? Something must be stopping you. Okay, over here.
My name is Alexander, and I came from Ukraine. I'm actually representative of a quite conservative industry, agriculture trading, and we simply don't have a stable coin in agriculture which can be used by our farmer for the financing and for the hedging and for the other purposes. So this is why I'm here, and that's why the main barrier that it is still not existed in our industry.
Okay, so it's the absence of a stable coin that you think could be beneficial to Ukrainian agriculture, improved payments and things like that. And so it's more learning about stable coins. Okay. If we go through like the key themes of this this session, security, interop, regulation. Who finds security to be a concerning angle when it comes to working with stablecoins? You seem to be better with shows of hands than actually saying things. So security, not too worried about that. Okay. Interoperability, the fact that stablecoins, may be issued on siloed blockchains, or they may not be interoperable with existing payment rails. Who's concerned about that? Okay. And regulation, lack of regulatory clarity, not knowing how these things are treated for tax purposes, not knowing whether they're crypto assets or money. Who's concerned about that? Okay, kind of toss up between security and regulation then. So let's talk about those. So Clarisse, what are some of the, I guess, unique challenges when it comes to security for stablecoins, basically? What makes, what additional security considerations do we have to take into account that we don't need to take into account when it comes to existing fiat money?
I think in the previous panel, we talked about few blockers for stablecoin adoption. We talked about standardization. We talked about items that were missing for tokenized assets, stablecoin, to be actually deployed globally. I think that this is an effort that is going in parallel, but the truth is that we've been missing use cases. We've had a solution in search for, or we had a solution in search for a problem, and we've been kind of turning a lot around, and obviously regulation for the longest time has been one of the biggest blockers, but now regulation has been set not only in Europe, but in Asia, in Middle East. We had enough places where we could start actually put in production a lot of use cases. What we see at Dfns, because we not only work with banks, but also with fintechs, is that we had the first players really building application leveraging stablecoins, meaning not the first use case of stablecoins, which is how to on and off ramp from DeFi, because that's how stablecoin has been a thing, right? It's just to enable DeFi traders to on and off ramps. But we had the first use case passed in 2021 of actually builders leveraging stablecoins on cross-border payments, right? Since then, we've been growing a lot on this use case. We're actually servicing clients that is a bridge. We got acquired by Stripe, and we actually had a lot of volume growing with them. And I think the reason why I'm going back to that is because we never talk about security as something that is monolithic and applied to every single use cases that is being built on Dfns. It's very much use case first, right? So if you're operating in a context where you're doing B2B cross-border payments via stablecoin, or if you're operating in a context where you're doing remittance application leveraging stablecoins, or if you're doing a banking application for businesses leveraging stablecoin, your whole security framework will be different. Why? Because your risk model is different, right? And you're always building your security according to a risk framework that is very depending on your use case. So I think, especially when you talk about stable coins, there's not one application of stable coins. There's several. There's the one that we see today, the one that are successful, the one that's actually make us come to this conference and think, okay, so what do we do with stablecoins? And if we drill down a bit on that, I think what we've seen is that we had players trying to do B2B cross-border stablecoins for the past 3 years, not being successful because, first of all, no treasurer will actually do a cross-border stablecoin if the bank cannot accept the stablecoin. They're not going to take this risk, right? It's a risk appetite that you will never actually do as a personal within a larger organization if it's just to optimize your trade by a couple of bips. What you're going to do, and the reason why you're actually leveraging stablecoins is when you have pain and when there's utility to it. And the reason why a player like Bridge was so successful and was that 1.1 billion acquisition by Stripe last year is because what they did was actually looking at the use case where stablecoins were actually solving pain. And there you've seen go-to-market like global payroll. How do I make sure as a company that is Scale AI paying hundreds of workers globally in the world by the hour, how can I actually make that more easily? right? And actually transfer one USDC to one wallet to this person because I pay them by the hour or even by the minute. Global payroll is definitely something that makes sense for stablecoins and where we've seen a lot of applications. When you're looking at this use case, the security framework is very different, right? So first you need to secure the transaction, but you also need to secure the place where the end user will actually receive that payment. So it's not just about the money in movement, it's also about the wallet that will receive that transaction. And so on our side, the way we've been designing our product is by making sure we had the modularity that would enable our clients to build this specific use case. Once again, there's not one setup fits them all, but more kind of use case by use case specifics.
Okay. And I think that's a really interesting perspective as well. You know, you've mentioned cross-border payments. You've mentioned, payroll using stablecoins and things like that. And one thing we can't really escape from there is the need for multi-currency stablecoins, the need for stablecoins that are denominated in currencies other than USD. As the gentleman over there said, you know, there isn't a Ukrainian stablecoin, which is a challenge if you're, participating in the Ukrainian agricultural industry and things like that. And I guess the other question then to you as an audience is, who is just not using stablecoins because there isn't one that is useful in the currency that you are focused on? Okay, so that's not the big blocker either. Right, well, I think, what we've heard from some of the other roundtables today as well is...
Because I think we're still exploring, right?
Yes.
And there's still a lot of exploration. I think what I really like about this conference is the fact that real life and real use case is meeting actually banks that have been looking at how to implement these solutions for the longest time. But to come back to your point about the multi-currencies, I'm going to challenge that. Do we actually need multi-currencies? So today we have 55% of our clients in Europe and 80% of the volume on our platform is in USD stable, whether it's the USDC, et cetera, et cetera. I'm going to pause 2 seconds on that. So what it means is that today we have, when you look at all these use cases where you have a stable coin in the middle of a transaction, in a cross-border transaction, et cetera, so the famous stablecoin sandwich, what we've seen is that the sandwich is becoming a burger with a very fat meat that is the USD, right? And it's very possible we're going to eat steak only in a few years, right? So in other words, we need, in my opinion, multi-currency because the infrastructure that is being built right now is very favorable for the hegemony of the dollar, right? And so I think here we're entering more into geopolitics conversation because the truth is that when you end up actually receiving USDC and you live in Mexico, you're happy to keep your USDC, right? You are actually hedging some sort of volatility on the currency rate. Plus all these players actually building use cases, leveraging stablecoins. They are offering you the wallet, so it becomes your bank account. They're offering you the yield, so you're actually starting saving and having interest rates on your deposit you did not have before in a money that is actually stable, right? And so today, in the real life, and I would say with use cases that we've seen being built, we've seen recently, a stable coin on Mexican peso, on Brazilian real being issued. But the truth is that we're still missing the use case. What is the use case? When do I swap from USDC to Brazilian real, right? What is going to be the use case that is going to actually enable for this stable currency to take off?
Yeah, absolutely. And I think, you've mentioned the geopolitical angle there. I think there's also the personal user experience. Yes, some people might want to receive US dollars, but really not everyone wants to take currency risk when they're being paid by their employer. Not everyone, wants to take FX risk and, have to manage exposure to the US dollar to, a currency that's not theirs when they transact day to day. And when we look at digital asset markets in particular, at the roundtable before lunch, Vik Chandran from Deutsche Börse mentioned, one of my favorite examples in the UK of Santander's issuance of the first tokenized GBP-denominated bond back in 2019. A huge blocker to them undertaking that initial transaction with another counterparty was the absence of a regulated on-chain settlement asset. So basically they had to tokenize their own deposits, which no one else wanted exposure to, and they did it as an intergroup transaction. Now, 6 years later in the UK, that still remains an issue. And you guys in the EU are a bit ahead of that in a way, that same structural barrier is being broken down now with the existence of MiCA and the slow growth of more accepted euro-denominated stablecoins, I think. But we can't underestimate the importance if we want to see the benefits of tokenized asset markets, if we want to see the evolution of a digitalized financial system, of having the ability to settle in the currency in which assets are denominated.
It's super important. No, of course, it's absolutely important. I think we've seen a lot of initiative on debt capital markets that do not take off because we're missing the cash leg, right? And so we're missing the settlements in the currency in which the assets are denominated. It's absolutely true. I think the question here becomes, until we have actually a digital euro, right, and until we have sort of almost of a top-down approach on this subject, how do we enable euro stablecoins, right, to gain TVL? Because today, when you look at the stablecoin in euro, they are very, very small compared to what you see in USD, despite the fact that in Europe, we were one of the first regions to have actually a regulatory framework. And so in my opinion, it's no longer a matter of infrastructure. It's no longer a matter of regulation. And so it's a matter of how do we bring that use case that is actually useful for euro? And there, I think something that could be missing and maybe a break to actually the adoption of several use cases is actually linked to the regulation. The fact that you cannot have yield-bearing stablecoin that are regulated under MiCA in Europe is preventing a lot of use cases that are more financial than cross-border payments or than any sort of remittance, which we would have a corridor between Euro and Africa or Euro and Asia, is very important. So people are turning to DeFi, right, when they want to actually provide that yield-bearing stablecoin, and that means that we're not pushing into the real economy actually stablecoin in euro. And that discrepancy between what we see as pertinent to the USD and what we see in the euro, I think could be a lot of blocked by the regulation that we have today.
And focusing in on euro stable coins in particular, and as you said, we're seeing lots of little euro stable coins emerging. This is normal at this stage of the market development. We would expect to see lots of fragmentation, and then later, further down the curve, a slow move towards consolidation as we move to adoption. But there are really specific challenges from a technical perspective when it comes to stable coins that can impact this sort of consolidation process. And I'm thinking here about interoperability. So when we use money today, we're not really thinking about where that money is, or technically, can I access it, or does my wallet support the blockchain that this stable coin is issued on, and things like that. And so interoperability and breaking down the barriers to fragmentation are really intertwined with each other. And how do you see that being resolved over time?
It's a really good question. We heard on the previous panel that, or was it the one before, I can't remember, that CBDC could be a way to actually provide liquidity for stablecoin or bank stablecoin, commercial bank stablecoin. And so to create that sort of interoperability within the commercial bank. But at the layer below, it's actually very fragmented, right? So over the past month, we've seen more and more interest from traditional fintechs that haven't been operating in blockchain at all, have not leveraged crypto before, to get into to expose themselves to stablecoins, and one of these players told me that it seems to me that if we don't issue a stablecoin by the end of the year, we're going to be out of the race. So I think what we're going to see this year, mostly coming from the US, but I expect as well a lot from the Europe, is a lot of fintechs starting issuing those stablecoins, so at the corporate level, right, which will be all issued on very different technology, which will be probably not all listed in the same exchange, so where the liquidity will be extremely fragmented. And I think we're missing that sort of layer in between what the role of CBDCs will be for a commercial bank stablecoin, and from commercial bank to the corporate world. And yes, first it's technology. How do we enable interoperability? So it goes through the infrastructure, making sure that when we're actually building retail use cases, we are wallets that are multi-chain, right? So that can actually weave in at the wallet level. We can have some sort of interoperability. Then after it's at the blockchain level, how do we enable faster, more secure bridges between chains, right? Is it through the help of centralized party that will be the liquidity providers, or can we actually have interoperable layers like, what we've seen with layer 0, what Chainlink is doing to actually bring the liquidity from one chain to another. And then again, after that, we need to make sure that we also leverage this interoperability from the corporate level to the bank level, and there I think there's still a bit of time before we achieve that part. So I think it goes back by, like, once again, we need to think about the use case. There's going to be some consolidation in technology. There's going to be some specialization of certain technology that will be more, that will attract more payment use cases, that will attract more financial use cases, and where we're going to see some convergence that will help in that space. And I think at the end of the day is making sure that when you start building, you build with, we're talking about the standards, but we build with the infrastructure that has the most modularity possible, so you can stay agile. You can stay agile on building for a certain blockchain, but maybe transitioning to another, and you can stay agile in building the pipes that are actually relevant to your traditional systems. So making sure that your payloads can be compatible with the Swift messages you're actually sending today in your traditional systems.
And this role of CBDC in the future that you touched on is super interesting. I mean, we often think of wholesale CBDC as being, the main anchor of stability in, a future tokenized commercial bank money system. But there's also the role of retail CBDC as well. And like you mentioned before, it's not just the ECB, the Bank of England has also explicitly stated that one of the roles that could be played by a retail digital pound is as the means of kind of functional interoperability between different privately issued forms of digital money, if everyone is required to basically provide conversion in and out of a retail digital pound, for example, then that breaks down some of the potential barriers that could be put in place by firms trying to create walled gardens. But I say functional because obviously you have to have some kind of useful technical interoperability as well to support that. But just to finish off, so we've talked, about all these different forms of money, and what do you see this future ecosystem of new forms of digital money, tokenized commercial bank money, tokenized central bank money in both wholesale and retail forms, stablecoins, in all their forms? How do you see this playing out? Do you see that one is going to emerge, a bit ahead right now, but we'll gradually see kind of settling down across time? Will they compete with each other directly? What's the future going to look like?
So I think that regulation is already kind of putting some trends in terms of what we see within the market. So first of all, in Europe, we're going to see more and more consolidations around stablecoins, and I don't think that eventually there will be a lot of stablecoins that are regulated just because of the capital requirements you need to make sure you can keep and maintain your stablecoin regulated in Europe. And so that is going to drive regulation. So even though we're talking about a lot of, the multiplication of stablecoins, the regulated one, there's probably going to be a few that will be remaining within the next few years, which means that the other one will be more associated to some sort of loyalty in-app program, right? So we'll see some stablecoins that will be more DeFi related, and will kind of bring that yield within the application, replacing slowly the way we're actually thinking about loyalty program. And I think there's going to be interesting things that are going to be developed, but mostly once again on the DeFi side, with stablecoins being liquid within other stablecoins, and eventually off-ramped into regulated stablecoins. It is going to be very interesting next 2 years, where we're going to be first a lot of fragmentation, but eventually, once again, because of the framework what we see, but also because of the infrastructure that we need to actually put in place to be able to develop these rails, I think that there's going to be more specialization of technology, more specialization of infrastructure provider, and convergence around certain standards and certain technology. Yeah.
Thanks, Clarisse. I think we're out of time. Very, very quickly, any quick questions? Gentleman over here.
Yeah, thank you. Peter Bofinger from Würzburg University. I have one question. When you talk about the market for stablecoins, what market dynamics do you expect? So isn't it, from an economic point of view, a kind of natural monopoly that we are facing with these stablecoins? And you can see it in the US. So there's only Tether, and all the others are almost insignificant. And so what is the process that we expect for Europe? Wouldn't it be the same thing, that we have this kind of natural monopoly? Or is it even too late because Tether is dominant already?
So with stablecoins that are not bank-backed or bank-issued, right, I think there's going to be a few of them. You're going to see Circle staying, Circle, and you have the EURC. You're going to see maybe a few players that have been very early into getting their license, that are very well backed, and that will be able to maintain. But in my opinion, there's going to be it's going to be close to a monopoly in those regions. Now, every single bank that we talk to is thinking about, how do I launch my stablecoin, right? Both in Europe and in the US, and that is going to create some competition. Now, it's all about distribution, right? So if you create a stablecoin that, in terms of use case, is more meant to actually leverage cross-border payment for your businesses, you're not going to compete on the payment side, right, for actually retail use cases. And so this is where I think there's going to be a rush from banks into actually going into those retail banks, because in those retail applications, because otherwise the monopoly is going to keep on growing, and whether we're in the US or in Europe, there's going to be a very, very few players. Yes, I agree with you.
I think we're being gently urged off the stage. So thank you all very much. Thank you, Clarisse. It's been really interesting talking.
Thank you very much.